Welcome to Business Decoded, where we break down how companies really make money. Let's decode today's business model. Amazon loses money on retail. The thing they're famous for, the thing you think is their business, loses money. When you buy a book or headphones on Amazon, they make almost nothing or actually lose money. Yet Amazon is worth over $2 trillion and made over $600 billion last year. How? Because retail is the bait. The real money comes from Amazon Web Services. Today, we're breaking down how Amazon built a cloud empire that subsidizes everything else, why retail is just the gateway to their ecosystem, how AWS makes more profit than the entire retail business, and why Amazon's willing to lose money on what they're famous for. Here's what we're covering: how AWS accidentally became Amazon's most profitable business, why Amazon operates retail at near zero margins on purpose, and whether this subsidy model is sustainable or anti-competitive. Before we begin, a quick disclaimer. This content is for educational purposes only, not business or legal advice. Company references are from public sources for educational commentary. Trademarks belong to their owners. Consult qualified professionals before making business decisions. Let's start with the truth about Amazon's retail business. In 2024, Amazon generated $638 billion in total revenue. Online stores generated $295 billion. Third-party seller services generated $178 billion. AWS generated $107 billion. But here's what matters: operating income. AWS generated $37 billion in operating income. That's a 35% operating margin. The entire rest of Amazon generated $33 billion combined. Oz, which is 17% of revenue, generates more than half of Amazon's total profit. North America retail generated $386 billion in revenue but only $16 billion in operating income. That's a 4% margin. International retail generated $149 billion but lost $3 billion. AWS generated $107 billion in revenue and $37 billion in operating income. 35% margin. AWS makes more profit than North America retail despite being less than one-third the revenue. This means retail is essentially break-even. Amazon sells you products at cost or near cost. They're not making money when you buy from them. They're making money from AWS, and retail is just the vehicle. How did this happen? AWS wasn't even supposed to be a product. In the early 2000s, Amazon built massive server infrastructure to handle holiday shopping spikes. Most of the year, that capacity sat idle. Amazon realized they could rent out excess capacity to other companies. In 2006, they launched AWS. It was supposed to be a side business. Instead, it became the most profitable part. AWS provides cloud computing infrastructure. Instead of companies buying their own servers, they rent computing power from Amazon. Netflix runs on AWS. Airbnb runs on AWS. Slack, Spotify, Lyft, all run on AWS. Even competitors like Target use AWS for their websites. Amazon built infrastructure to support retail, then turned it into a product that makes more money than retail itself. The genius is the business model. Retail is low margin, high volume, capital intensive. Oz is high margin, scalable, low marginal cost, and has network effects. Once you build on AWS, switching is painful. AWS also benefits from economies of scale. More customers mean more infrastructure investment, which makes the service better and cheaper, which attracts more customers. Here's why Amazon is willing to lose money on retail. Retail is customer acquisition for everything else. You come to Amazon to buy a book. Amazon sells it at near cost. But now you're in the ecosystem. You see free shipping if you join Prime. You sign up. That's $140 per year. Prime members spend more on Amazon, so the subscription pays for itself. But Amazon also bundles Prime Video, Prime Music, and other services. The more services you use, the stickier the ecosystem becomes. Amazon also makes money from third-party sellers. When you buy from a third-party seller, Amazon takes 15% commission. They charge sellers for fulfillment, storage, and advertising. Sellers pay Amazon to access Amazon's customers. This is pure profit. Amazon isn't buying inventory, shipping products, or taking on risk. Third-party seller services generated $178 billion with high margins. Then there's advertising. When you search for a product on Amazon, the top results are ads. Sellers pay Amazon to rank higher. Amazon generated $51 billion from advertising in 2024, with margins estimated at 50% or higher. So retail breaks even, but retail enables Prime subscriptions, third-party seller fees, and advertising revenue, all high margin. Retail is the loss leader. But AWS is different. AWS doesn't need retail. AWS customers are businesses. AWS grew because it's genuinely the best cloud platform. It has more services, better reliability, and more scale than competitors. AWS still has 31% market share, more than Azure and Google Cloud combined. AWS also has incredible unit economics. Once Amazon builds a data center, the marginal cost of adding another customer is low. Software scales infinitely. This is why AWS has 35% operating margins while retail has 4%. The subsidy model is what makes Amazon dangerous to competitors. Walmart, Target, Best Buy all have to make money on retail. Amazon doesn't. Amazon can price retail at cost because AWS covers the losses. This lets Amazon undercut everyone on price. Competitors can't match Amazon's prices without going out of business. This is why regulators are concerned. The Federal Trade Commission sued Amazon in 2023 for anticompetitive practices. The argument is Amazon uses AWS profits to subsidize retail, creating an unfair advantage. This could be predatory pricing, which is illegal. Amazon's defense is they're pricing low because they're efficient. Automation, logistics, scale create real cost advantages. The low prices benefit consumers. The second regulatory concern is the third-party seller platform. Amazon controls the marketplace. They see all sales data. They know which products sell well. Then Amazon launches their own version, underprices the third-party seller, and promotes their own product. This is using platform power to compete with your own customers. For you as a consumer, you benefit from Amazon's low prices. If AWS subsidizes retail, you get cheaper books and electronics. That's good short term. But long term, if Amazon drives all competitors out, they'll have monopoly power. Then they can raise prices. Amazon also has incredible power over sellers. If you're a small business selling on Amazon, you're dependent on their platform. Amazon can change fees, change the algorithm, or launch a competing product. The AWS dependency is also concerning. If your business runs on AWS and Amazon raises prices, you're stuck. Migrating off AWS is expensive and risky. So far, AWS pricing has been competitive because Microsoft and Google are viable alternatives. But if AWS achieves dominance, they could extract more value. There's also whether this model is sustainable. AWS faces increasing competition. Microsoft Azure is growing faster. Google Cloud is investing heavily. AWS market share is declining from 40% in 2020 to 31% in 2025. If AWS loses its edge, Amazon loses the profit engine that subsidizes retail. Cloud computing is also maturing. Growth rates are slowing. AWS margins could compress as competition intensifies. The bull case is the flywheel keeps spinning. Retail drives Prime. Prime members buy more. More purchases attract more sellers. More sellers mean more selection. More selection attracts more customers. This feeds advertising and third-party fees. Meanwhile, AWS dominates cloud and prints money. The bear case is AWS growth slows, competition intensifies, margins compress. Without AWS subsidies, retail can't sustain low prices. Regulators break up Amazon or force them to operate retail profitably. For you, Amazon's low prices come with trade-offs. You save money, but you're feeding a system that concentrates power and disadvantages competitors. Whether that's good depends on whether you value short-term savings over long-term market health. If you're a business, AWS is excellent. It's reliable and cost-effective, but you're building on Amazon's platform. If they change terms or raise prices, you have limited options. Here's what to do. As a consumer, recognize that Amazon's low prices are subsidized by AWS. If you value competition, consider buying from other retailers occasionally. As a business, if you're on AWS, have a contingency plan. Understand your migration costs. Now, next time on Business Decoded, we're examining Microsoft's transformation. They went from a Windows-centric dinosaur heading toward irrelevance to a $3 trillion cloud powerhouse. Amazon loses money on retail, but AWS generates more profit than everything else combined. $37 billion in operating income from cloud services. Retail is the bait, Oz is the hook. The subsidy model lets Amazon undercut every competitor. Whether that's brilliant strategy or anti-competitive behavior depends on who you ask. Either way, Amazon's business model is not what you think. And that's how they built it. If this helped you understand business better, subscribe for weekly deep dives into the world's most successful companies. Thanks for watching.